Good morning and welcome to the second half of the 31st annual meeting of the Wisconsin Coalition of Annuitants. Once again, we're meeting virtually because of the COVID variants and the fact that the facility where we'd held our meetings in the past is not open to outside users. Hopefully next year we'll see you in person. My name is Sandy Drew. I'm a member of the board and I'm filling in this morning for our chair, Bob Schaefer, who is en route to the West Coast. A few housekeeping items before I introduce our first speakers. First of all, everyone will be muted during the presentations. However, you will be able to ask questions at any time by pressing the Q&A button that can be found on your screen. Just click on the symbol and type in your question. Speakers will respond to the questions at the end of their presentations. Only use the chat button if you're unable to access the Q&A button. Also, please remember to respond to the short survey at the end of the program. Now, it's for our first speakers. It is my pleasure to introduce Edwin Denson, Executive Director, Chief Investment Officer at the State of Wisconsin Investment Board. Edwin joined SWIB in 2018 as Managing Director of Asset and Risk Allocation. He was appointed to his current position in April 2021. Before joining SWIB, Edwin had extensive experience in the financial world, including Managing Director at the Canada Pension Plan Investment Board. He holds a bachelor's degree from Cornell University and a PhD in economics from Northwestern University. Joining Edwin today is Leo Kriviansky, who joined SWIB in 2019 as Managing Macro Analyst, Asset and Risk Allocation. Before joining SWIB, Leo had served several years' experience in economic research and management with several management and investment firms. He holds a bachelor's degree in economics from Dartmouth College and a PhD in economics from the Massachusetts Institute of Technology. Also joining Edwin and Leo is Rochelle Klaskin, who is Deputy Executive Director, Chief Administrative Officer. Rochelle joined SWIB in 2015 as its Chief Legal Counsel. Prior to joining SWIB, she was a shareholder in the corporate practice group at the law firm Godfrey Kahn and served as the managing partner of the firm's Madison office. She earned her law degree from Chicago-Kent College of Law and a bachelor's degree in journalism and mass communication from the University of North Carolina, Chapel Hill. Welcome, Edwin, Leo, and Rochelle.
Well, thank you very much for that introduction, Sandy. It's an honor and a pleasure to be able to appear at this annual meeting and give you the update on what's been going on at the investment board, those of us who are in care of your retirement assets. So to start, if we can hit the next slide.
Just a minute. You guys can see my screen, correct?
Yes. Yes.
Great. Let me just advance the slides. And perfect. We're in business, I think, then.
Okay. So we're going to start talking a little bit. I'll talk a little bit about performance, mainly focusing on our longer term results, but then also giving you a bit of an update on more recent developments. And then I will turn it over to Rochelle to talk about our cost management and cost effectiveness. Then I will take over and talk about asset allocation and the changes that we've made recently and are implementing throughout this current calendar year. Then I will turn it over to Leo to give us an update on the market. And then finally turn it back over to Rochelle to talk about general SWIB news. And then we will have time for Q&A. So as a reminder of the scale of the assets that you all have entrusted to us, as of the end of 2021, we had approximately 147 billion in assets under management for the total WRS, comprising 136 billion in the core trust fund, or the CTF, and around 11 billion in the variable trust fund, or the VTF as it's also known. And you can see in the far right column the changes there in terms of the increase in assets, and that is due both to the nice returns that we saw in capital markets in general last year, in addition to our investment activity. Here we can see the performance of both the core trust fund at the top and the variable trust fund at the bottom, both on some shorter term bases and on a longer term basis. So here, if we focus on the core trust fund up top, the year to date, because this is as of the end of December 2021, that's calendar year 2021, and you can see a very good return in the year, not only on an absolute basis, the 16.89, but also relative to the benchmark, and that 0.65%. Or 65 basis points, that's the value that the investment staff and our external partners were able to add via their active investment activity over our policy benchmark. And then you can see actually what's really more important are our 5-year, 10-year, and longer term returns. And you can see that on all of the longer term timeframes, we've delivered both good absolute returns relative to the assumed rate, which is the rate that's estimated to be the rate of return that we need to deliver to keep the WRS viable over the long run. And that's currently at 6.8%. And these returns also look very good compared to the 5% that's required for us to be able to deliver dividend adjustments on an annual basis. And then again, in terms of our investment activity, both the internal activity and the activity of our external partners that we select, you can see that we are positive there in the green on all of the timeframes as well in terms of that activity. Focusing on what those numbers, those look small, something like a 0.65% or 0.43%, et cetera. The fact of the matter is that given the scale of assets we are managing, that value added over benchmark really translates to real money. We've added 2.2 billion in value over benchmark over the last 5 years. Now this exhibit is a little busy, but I'll take you through it. It demonstrates the value that we've been able to add over the longer time frame, so over the last 20 years. The blue line indicates the cumulative return to a simple, cost-effective investment in a 60% allocation to global equity and a 40% allocation to domestic fixed income or US fixed income. So if you had this passive low-cost implementation, that's the cumulative return that you would have received. So $100 invested 20 years ago would be worth $397 now. The yellow line represents the return to our policy benchmark or our more diversified asset allocation. So rather than simply sticking with global developed equity and domestic fixed income, in our policy, we also have private assets like private equity, private debt, venture capital, and real estate. And we also have a more diversified exposure to public equity than just a global developed large cap. We also have exposure to emerging markets and also to other parts of the capitalization spectrum, so mid cap and small cap equities as well. And again, that yellow line represents the benefit to having a more well-diversified asset allocation through time. And then finally, that top line in this chart represents the actual cumulative return that we've delivered. And so the difference between the top line and the yellow line is, again, the benefit that we have from actively managing within these asset classes both using internal resources and utilizing external partners. And again, to translate that to real dollars or to money, we can see that our policy has helped deliver $23 billion over that low-cost alternative over the last 20 years. And in addition, that active investment activity that we engage in has added another $11 billion over the 20-year period. So having an investment board like ours and the resources available for us to utilize and the platform and the complexity have contributed $34 billion over the last 20 years, again, relative to a simple passive alternative. Okay, this exhibit helps us see how we are doing relative to other large public pension plans. And so on a number of time frames, so last quarter, last year, last 3 years, last 5 years, last 10 years, what the gray rectangle represents is the distribution of outcomes for all of the pension plans or the dispersion. And then within that, the green rectangles show where our policy benchmark returns helped us land relative to our peers. And then what the blue dot represents is if we take into account our active investment activity as well, where does that leave us relative to peers? And you can see again that on the longer term time frames, the 3-year, the 5-year, and the 10-year that are most important to us, we've fared up pretty well relative to peers. And we hope to keep that up. Again, there can, in any one particular quarter or one particular year, we may not look so good, but at times, however, again, over the long run, due to our sophisticated and diversified asset allocation, and also our active investment activity has really served us well over the longer time frame. This exhibit demonstrates our active investment activity that I was referring to versus the results of the active investment activity of peers in general. So you can see our cumulative value added through our investment activity over time is represented by the blue line, and that of peers is represented by the yellow line. And you can see that for several years, although we were adding value, our peers in general were adding more value. We were employing a very disciplined, sort of slow and steady wins the race, very tightly risk managed active portfolio. And then you can see that starting at about middle of 2018, the peers as a whole started to slide back in terms of their value added over their benchmarks. And then you can see that if you look at early 2020, both the peers and our investment board suffered a bit of a setback during the COVID crisis. But then you can see that when markets recovered, we were able to recover as well in terms of our value added, and continued on and stuck to our knitting and stuck to our discipline. And again, the slow and steady has continued to win the race in the period after that. And again, peers have kind of fallen behind us now and seem to be, I don't know, for lack of a better word, a little bit lost in terms of what they should be doing with their investment strategies. And again, we've just continued to stick to our knitting and stick to our discipline and our long-term strategy, and it has served us well. Now, focusing on the more recent time frame, so just the last quarter. So again, everything we've been talking to up to this point has been through the end of calendar 2021. And of course, you're keenly interested in what's been happening this year, given what's been happening in markets. And as you can see, we have experienced a negative return in the first quarter of minus 3.45%, the policy benchmark minus 3.72%. So although we've added a little bit of value through our active investment activity, the fact of the matter is that there's a very serious headwind right now going on with all major asset classes providing negative returns year to date, and that has had an adverse effect on our performance for short term for the year to date. But again, as you can see, if you look at the 5-year and 10-year timeframes, we continue to look very good relative to both the assumed rate of 6.8 and the implied annuitization rate of 5%. Now, I would like to make some comments as well about April and May. We don't have the official final performance statistics yet, but we have continued to experience adverse outcomes, again, as almost every asset class has continued to go down in value, not just equity and risky assets, but even safer assets like fixed income and even US Treasuries have experienced negative returns. Now, we like to keep in mind that that we did see really high returns, north of 15% in each of the last 3 years. And in some sense, those high returns did detract somewhat from forward-looking expectations. And the way we think of it is that the easy monetary policy and significant fiscal stimulus of the past few years helped pull some of the economic growth that we would have normally seen in the future forward to now, as well as pulling capital market returns forward in time. And we think that now we're just seeing a bit of a give back on that. Again, our longer term returns in the context of this remain very robust relative to both that assumed rate required for the long-term health of the retirement system and relative, again, to that approximate 5% required to provide the annual increases in benefits that we provide when we can. I just want to let you know that we will delve more into what's going on now in capital markets a little bit later in the presentation when Leo Krapowianski speaks. But for now, I'd like to turn it over to Rochelle.
Hi, everyone. So like any business, we're focused both on the revenue and return, and in our case, investment return, but also on our cost effectiveness. So in connection with costs, we hire an independent consultant. Their name is CEM. They're out of Toronto, and they collect costs on about a year delay so they can analyze that from public pension plans across the world as well as across the United States. And we ask them to look at our costs comparative to our peers, as that's one measure of our success if we can optimize the way that we spend money and balance that against the return. So in connection with what CEM does, they do 3 comparisons for us. One is against the US public market as a whole. So these are the 49 largest public funds. They do that. They also kind of compare our costs, and they look at a benchmark cost that says, okay, given everything that you guys do in your house, this is what we'd expect the cost to be. And then they also measure us on a third way, which is against a select portion of the peers, which is sort of the 15 largest funds. So we'll review all of those comparisons in just a bit. So you can see that for, and this is 2020 data. As I said, this is a year delayed because it takes people that time to get the information in, and it takes a while for their analysis because they review every single cost that we have in the house. And so you can see that the average cost for the US public funds was 61.7 bips. Those are basis points, compared to the SWIB cost of 52.4 bips. So we had a 7.9 bips of savings, which adds up when you're looking at that $140 or so billion for 2020. Now, in addition, when CEM looks at everything that we're doing and how we do it and how we implement it, they thought our cost should be about 53.8 bips, and we spent 52.4 basis points. And you can see we did have about 1.4 bips of savings. So again, even 1.4 bips of savings is $15 million worth of savings. You compare this 7.9 basis points, and that's $87 million worth of savings compared to US peers. So we have those 2 ways of comparing. And then we also look at sort of that 15 largest peer, what they call the peer median, 15 largest funds out of that state, out of that 49 US public funds. And this is one area where for the first time, we actually looked a little bit higher, 6.2 bips. But when we dug into why, we actually found this was a good problem to have. It was driven primarily by our hedge fund portfolio in 2020. So hedge funds work where when they are performing, the majority of that revenue and performance comes to SWIB, but you also pay a little bit more when they are performing. So in 2020, we had top decile performance for our hedge funds. So we paid them a little bit more, but on the revenue side, that's not on this slide, this is just the cost. On that revenue, we actually had higher returns relating to that. Now, we also asked, okay, if we just had median return, median pure hedge fund return, how would our costs would have looked? And it turns out that if you would have compared that version, we would have had a little less than 1 basis point less than the pure median if we had just had average performance. So we believe that this is one of those moments where paying some higher fees gets you more revenue or more return. And even though it wasn't as optimized from a cost perspective here, it was optimized on a return perspective. So we think on all 3 measures, we were doing extremely well for 2020. One of the reasons we do that is we know we have both external management and internal management. So there's lots of places where it makes sense to be partnered with external management, such as private equity, certain types of hedge funds, also kind of niche kind of investing, such as emerging market debt and so forth. But when we can have a strategy that we can run internally from Madison and get the talent and retain the talent to do that here, we do try to take advantage of those strategies. And you can see when we do save money. So for example, doing global large cap equity internally is about 15 basis points of cost compared to a US average cost of 41.9 basis points. Similar with small cap equity as well as domestic fixed income. So we feel the balance that we're able to maintain, which is about 50% internally managed here at SWIB, goes to the benefit of WR beneficiaries where we can deliver returns as well as save costs on the long term. And then finally, because we've done this study with CEM over a number of years, we can kind of accumulate those costs over time. And what did those savings look like at the top when I talked about those additional basis points from our peers? And this actually over the last 10 years has saved $1.1 billion in costs when you compare the costs that our peers sent. So we believe that from a return perspective, hitting the assumed rate while at the same time being thoughtful and optimizing our costs works for the advantage to the WRS. And now I'm going to turn this back to Edwin to speak about asset allocation.
Great, thanks. So these are the current targets that we have for broad asset classes. So public equity, public fixed income, inflation sensitive, which in our case is entirely allocated to TIPS or Treasury inflation protected securities of the US government, an allocation to real estate, and then also one to private equity and debt. And I just want to point out that this is a simplification. These are top line asset classes. Within each, there is quite a bit of a diversification, as we'll see, in particular in public equity and public fixed income in the next slide or two. Here we can see the current policy that we just saw on the pie chart is the middle column on this exhibit. And so you can again see the percentages allocated to each of the major asset classes. But in addition, you can see towards the bottom the expected return associated with that asset allocation. So you can see that on a 10-year basis, that asset allocation is expected to return 5.4%. And on a 30-year basis, so much longer run basis, that asset allocation is expected to provide a 6.6% return. Now you may be asking the question, well, if the assumed rate is 6.8, why are you targeting an asset or why do you currently have a target asset allocation that provides a lower return than that? And the answer is tied up into something I referenced earlier, which is that the very high capital market returns that we've seen over the last 3 years have led to a decline in expectations in general for asset class returns on a go-forward basis. And in order to have an asset allocation with a return as high as 6.8 or even higher, we think is just too risky, and we'll be able to talk more about that why when it comes in a further slides where we talk about the comprehensive stress testing that we do of the retirement system to gauge long run viability. So talking a little bit more again about those allocations in public equity and public fixed income and inflation sensitive assets. What we are doing on the public equity side is attempting to have or endeavoring to have our public equity exposure look like the global equity market, both in terms of geographic exposure and diversification and in terms of capitalization spectrum diversification and exposure. So what that means is including all parts of the US market, both large, mid, and small cap, and also attempting to do that outside of the US as well. So we are being very strategic here about our emerging market allocation. Again, we are adding emerging market small cap to get more of that geographic and capitalization spectrum diversification into our policy. And then in the emerging market world, we include about a 30% weight to China. But what we are doing is breaking the China exposure out separate from the emerging market exposures, excluding China, and having only a half weight to the large cap China, but otherwise full weight to other emerging market geographies. So the short of it is having our public equity exposure look like the global equity market, excepting having only a half weight to large cap China. And then in the public fixed income inflation sensitive areas, we are maintaining our US focus, and we are also shifting our exposures to where we think we can benefit from active management. So that means moving into areas of the fixed income market that are less efficient, and that translates to exposure to high yield bonds, to loans, and to emerging market debt, and less reliance on investment grade corporate bonds than previously. We're also including an allocation to longer dated treasuries, and what that does is that helps provide more diversification benefit and also helps us maintain our duration or interest rate exposure that is beneficial in most, but not all, market environments. And on this exhibit it's a little bit busy, and there are a lot of little sort of acronyms here, but this is the result of the stress testing that we engage in every other year in conjunction with the ETF and with our actuarial consultant. And again, what we're doing is looking at the long run viability of the retirement system by looking at what different asset allocations could mean in the future for contribution rates and for dividend rates and for the probability of depleting the dividend surplus, and then also what the implications could be for the funded status of our system, which, as you all know, has been fully funded for a very long time and is considered one of the most well-run and most well-positioned pensions in the United States. So if we go to the far left of column, the ROR means rate of return. And so what we're doing here is looking at different asset allocations that provide different returns. And then the next column is, that means standard deviation. So that's the risk associated with any particular asset allocation. And then as you move to the right under contribution rates, what 95th, 50th, and 5th percentile mean is the 50th percentile is sort of the average expected outcome or implication. And then the 95th and 5th are sort of the extremes. So again, what we've done here is take a particular asset allocation and simulate the possible outcomes of that thousands of times to get, again, a distribution of outcomes. And so what we can see is, again, with contribution rates and let's say a 6% rate of return, that we would end up with on average a 13.6% contribution rate. And in the sort of towards the best of outcomes, the contribution rate could fall to as low as 7.7%. And kind of on the other end of the spectrum with that asset allocation, it could end up being as high as around 17%. And then as you again go across the table, same interpretation, with the dividend rate, you can see that with a 6% return asset allocation, that the dividend rate could, the dividends could increase 0.7% per year, but in the best of outcomes, something like 4.5, and on the worst of outcomes, something like a -3. And then finally moving over to the right, far right, the highest dividend depletion probability, 10% over a 10-year period. And then the worst funded status we see is that we'd be at 90% on that time frame. And it's really a balancing act here where if we run a really hot asset allocation, so if you have a rate of return, say of 10%, just to use an extreme to make the example, over the long run, the plan would be very well off, but over the short run, there's very high probability or unacceptable probability of depleting the dividend and creating a very high stress on contribution rates. So if we run too hot, we'd be good in the long run, but in the shorter term, we'd have a lot of variability in the benefit payments. And on the other end of the spectrum, if we ran a very, very cool asset allocation, so 4%, say, you have a very little chance of actually depleting the dividend over the shorter term, but the longer run implications of not taking enough risk are not very attractive. As you can see, you could end up having a funded status of as low as 60%. So we need to be in what you could think of as a Goldilocks zone. So we need to take enough risk to leave us in a good place over the long run, but not so much risk that we create a lot of viability or variability on a 5-year return basis. And one other thing to point out, just to help everyone understand how much the asset class return assumptions have come down because of the really good experience that we had with those returns in 20 and 21, is that final bullet, or the second bullet here, that if we look at scenario 3, back in 2019 when we did this exercise, the asset allocation that you would need to achieve a 6% return only had a 10.7% risk or volatility associated with it. And for 7% return target, you only needed just shy of 15% risk to hit that target. Now you need basically 50% more risk in order to achieve that same return target, because with those lower return expectations for all asset classes, in order to hit a particular return target, you just need to have a lot more of your exposure in equities and in the riskier assets, and that leads to the higher risk associated with any particular return. So we're letting discretion and caution here be the better part of valor, and at this time, again, running a bit of a cool asset allocation because we think that's prudent. And now I want to turn it over to Leo. Again, Sandy introduced Leo at the beginning. He's macro analyst in our asset and risk allocation division, very senior person, and his focus is a lot on thinking about economics and the economic fundamentals and how those translate potentially to the capital market outcomes that we could expect to see over the near and medium term. Leo?
Okay, thanks, Edwin. So can everyone hear me okay?
Yes.
Okay, great. So I think this is a chart showing the kind of inflation outlook that's priced into in the U.S. government bond markets over the coming 5 years. And I think it tells a pretty interesting story. Certainly a surprise in inflation over the last year or so has really been driving markets. It's been driving what the Federal Reserve will be doing with interest rates. And of course, we as consumers are kind of feeling the effects of inflation that's running quite a bit higher. This is a measure that shows what markets expect inflation to be over the coming 5 years. So I draw your attention to the very lowest point on the chart. That would be in early 2020, right, as we were going through the COVID shock. At that point in time, the market expectation was that inflation would only average about 0.5% per year over the coming 5 years. So it was a very low level. There was an expectation and an uncertainty about how long the COVID downturn would last. And markets were thinking it would lead to quite low inflation. I think in the event, as Edwin noted, there was quite a bit of fiscal stimulus from the US government to support the economy during COVID. And as well, the Federal Reserve lowered interest rates very aggressively from 2.5% to 0%. I'd say this recovery in inflation expectations that happened over the course of 2020, and if you kind of follow the blue line, by the end of 2020, these are back to about 2%. And that's, I would characterize that as a pretty healthy development, economy recovering, inflation getting back not to an excessive level, but something normal like 2%. I think it's fair to say that this further movement up in this graph over the course of 2021 and 2022, it really represents inflation that's getting out of control. And it is, arguably, we kind of overdid the fiscal stimulus, particularly the second federal government fiscal package in 2021. And perhaps the Fed kept interest rates a little bit too low for a little bit too long. And as Edwin noted, we had very good capital market returns over the course of 2020, 2021. And the unfortunate payback that we're going through at this moment is we've had great capital market returns, but it's also the case that inflation really is just running too high now. And the Fed has decided they really need to step in, raise interest rates in order to try to cool the economy down and bring inflation back under control. So periods where the Fed is somewhat behind the curve, raising interest rates to control inflation, are periods where really all of the major asset classes are doing poorly. Because inflation is somewhat high and because the Fed is raising interest rates, usually fixed income, even government bond prices are falling. As well, this intention by the Fed to deliberately slow the economy down in order to bring inflation under control means that, hey, earnings growth of various equity markets, they're expected to slow down, and typically equities are also coming down in price as well as bonds. So we've described it as periods where the Fed is behind the curve and raising rates to catch up. There's really nowhere to hide in terms of the major asset classes. During more normal environments, when equities are going up, bonds might be going down, but just a little bit. When in some periods bonds are rallying, when equities are selling off, this is a period of very aggressive Fed action that leaves us with kind of at least for a while, a nowhere to hide kind of environment. So here you can see, and let's concentrate on the lowest blue line on this chart. This represents the market expectation of where the Federal Reserve will take interest rates by the end of this year, by December of 2022. So if we dial back to October of last year, it was expected that we would end this year, 2022, with still very low interest rates, a little over 0.25%. Between October and let's call it February, October of last year, February of this year, it became pretty clear inflation's out of control or becoming out of control, and the Fed is going to have to move more aggressively. The idea of where they'll be by the end of this year came up to call it 1.5%. Since February, we've had further shocks to the global economy, particularly the conflict between Ukraine and Russia, which has driven up oil and food prices. It's going to have some inflationary implications for the US as well as the rest of the world. And right around that 25 Feb mark, you can see that, again, the expectation of how quickly the Federal Reserve has to hike rates has once again started moving sharply higher. And it currently sits at just about 2.75% by the end of the year. So this is, by recent standards, what is expected as a fairly rapid period of rising Fed interest rates. And I'd say, again, this together with, Ukraine conflict, some other issues, I think explains pretty well why both equity markets are declining. That's due to a realization that the Fed is deliberately slowing the economy. It's going to deliberately cause that the earnings of companies grow more slowly. And that just the rise in interest rates itself that the Fed is going to engineer also makes current low yielding bonds unattractive and leads to a decline in bond prices. So hopefully this adjustment in markets will, it's still running its course. The only nice thing about these nowhere to hide environments is they don't last forever. And, it's a matter of when they've run their course being well positioned for subsequent recovery. So these are pretty simple charts, just simply showing stock prices in a number of markets throughout the world. Let's concentrate on the top of blue one, which is the US stock market. It kind of reached a peak earlier in the year, call it late January, and it has been correcting downward ever since. And the story is not dissimilar in other global markets. The world ex-USA, which is green, represents developed markets other than the US. That's also correcting, as are emerging markets. And probably go to the next slide. So these are some simple measures of how rich or cheap stocks are. And once again, let's concentrate on the blue chart in the upper right corner. So the so-called price earnings ratio, and it measures the price, in this case, of US equities relative to their earnings or relative to the profits that they're currently generating. How much does an investor pay for the current profits? You can see that this PE ratio has corrected, fairly dramatically from very high levels. But we judge that, it still remains somewhat away from its longer term average. Both simple indicators like this and some other fair value models that we run say that stocks are cheaper now than they used to be in the US, but it might not be quite to the sort of bargain basement levels that would, make them particularly attractive as an overweight. And some of the other global markets, pivoting away from the blue chart and looking at the others, these have also corrected. Price to earnings have corrected, and they're probably in some other parts of the world becoming more interesting. They're back to what we would call more normal valuation levels, and there might be places that are even a bit cheap. I think the next chart So the previous chart again emphasizes that equities have been suffering very poor performance year to date. This again highlights that not only are equities getting it, but here are some 10-year government bond yields. So again, as bond yields go up, that means the price of bonds is falling. So we've had, particularly sharp pickups in yields, decline in bond prices in the United States as government bond investors demand more protection against inflation, and as it becomes clear that the Federal Reserve is going to be hiking interest rates pretty quickly. And we've seen not dissimilar sell-offs elsewhere in the world. These are some credit spreads. These are measures of what risky bonds which sometimes default. These are typically the obligations of corporates. This represents what kind of a spread they pay over in yield terms over safe things like government bonds. So as these charts kind of move upward, the spread over government bonds increases. We would say that taking risk in these credit asset classes is becoming more attractive. We are definitely keeping an eye on some of these, and our judgment at the moment is that it's while these credit risky bonds are becoming more attractive, they are not quite cheap enough at these levels for us to begin initiating an overweight, but we think of them as getting potentially pretty interesting in coming weeks. Okay, next chart. So this is again simply highlighting that there's been a big upward revision in global inflation forecasts over the course of the last 2 years. We've looked in some detail at some of the US data. This just emphasizes that there's really a similar picture happening throughout the world, within European markets, and to varying degrees also in EM. And again, it's just an unfortunate fact that when we're enduring a period of surprisingly high inflation, the price that societies have to pay to bring that inflation under control is typically central banks raise interest rates. They deliberately slow down economies. That will, in time, bring inflation back to more normal levels. But in the meantime, you're typically enduring slower growth, which is bad for equity markets. And the fact of raising interest rates itself is causing bond markets to sell off. And you're left with, again, what we would call kind of a nowhere to hide environment, where we've just got to endure a period of underperformance in both bond and equity markets, and be vigilant for when the smoke clears to be positioned well into a rebound. So thanks for that. And I think that we will be ready for questions at this point.
Actually, Leo, we just have one more slide that we're going to pop through,
Yeah.
And then we will definitely have questions available. Just want to give a little bit of quick news, and I apologize. I think my video didn't come on before, and if that was the case, my apologies. Just want to let everybody know this was in the May WRS News as well, but we have a few new trustees on the board as of 2021. Clyde Tinnen joined us in 2021. He is a corporate attorney from Foley & Lardner in Milwaukee who focuses on private equity. Kathy Blumenfeld is the new DOA secretary under the Evers administration, who started this year. And then Esther Ansell and Barbara Nick were reappointed to the board for another term. So a strong board of trustees who acts as an oversight and monitoring board, and where we meet quarterly. And then finally, many of you know that on our website, we've got lots of information about SWIB, not just about our meetings, but also about our investments, our performance, And in addition, we have a podcast series. So this is an opportunity to take 20 minutes and learn a little bit more about lots of different aspects about SWIB. Episode 15, we actually do an outside interview with the National Institute of Retirement Security Executive Director, Dan Doonan, who talks a little bit about pensionomics and what does the effect of benefits being paid in Wisconsin mean for the overall economy in Wisconsin. And then episode 16, we talk a little bit about how technology really drives investment decisions and what those important things mean for how we invest the funds today and the intersection between those technologies and investment.
Laura Dresser, who is Associate Director of the Center of the Wisconsin Strategy, or affectionately referred to as COWS at the UW-Madison. She is a labor economist and expert on low-wage work and workforce development systems. She has both written about ways to build stronger labor market systems and worked extensively with labor, business, and community leaders in building them. She is currently working on the connections between quality care, quality jobs, and minimum wages. We'll hear how those connections affect current and future retirees. Welcome, Laura.
Hi, everyone. Sandy, thanks for the nice introduction. Happy to be with you all today. I'm going to put a few links in the chat before I start sharing, because these might be resources that you'll see in my PowerPoint, and they might be of use to you. I'm also wondering, this is workingwi.org, the home of all of our State of Working Wisconsin reports. And there you will also find the annual report from 2021, where I draw some data, and the Job Watch, which has monthly jobs data. Oops. See. So these are the 3 links in the chat. And I also wondered, maybe, because I know Zoom can be tiring or feel a lack of interaction. Maybe I can't see you, but maybe everyone could throw in the chat a number between 0 and 10 about how you're feeling about the economy right now. 0 to 10, how you're feeling about the economy in the chat, just to see what we're thinking. Oh my goodness. Stunning unanimity. Well, not permanent. So thanks for those who weigh. I welcome you all to weigh in. I'm seeing optimists and pessimists, but mostly just kind of 5ers here, huh? A lot of 5s. All right. Thanks, everyone. I know you can, I do want to say that I do this, I talk about the economy a lot. I'm happy to talk about what's interesting and important to you. I'm going to do a lot of frame setting. If there are things you want me to slow down on, or questions you really want to engage with right away, please throw a question in the chat. I think you can raise your hands and get unmuted, or maybe you have to throw it into the Q&A, but I'm happy to be trying to interact a little bit as we go along. So let's make this a conversation. Oh, I know I'm going to put one other link in the chat. A two. There's a couple 2s. Nobody's very optimistic. That's fair. I'd like you to put what you think the biggest problem with the economy right now is. I would nominate 3 ideas, but you might have others. I think a lot of people are super concerned about labor shortage. A lot of people super concerned about inflation, and a lot of people super concerned about COVID. But also income inequality, a good nominee as well. Climate, excellent to point out. These are the things we're thinking about. So some of what I do will touch on things you're concerned about. Some of what I would do will point away from that, but we can come back around to those things when we have a time for Q&A. Thank you all for weighing into the chat. Continue to do so. I'll try and keep an eye on it. It's a little harder once I'm sharing this screen. But hopefully some of this stuff is useful. Okay, so now I'm going to share this. I'm going to share this as a slideshow from beginning. That should look good to you. Let me know if it does not. And I'll keep the chat open down here. And watch for stuff in there. Okay, so I want to talk a little bit about, oh my gosh, why can't I move this forward? Whoa. Wow. I'm not a, oh, okay, that worked. All right, so for today, I'm going to cover a little bit about me and about cows, a little bit about the COVID economy and what happened, and a little bit of some longer views, some problems, some policies. That's my plan. I'm anticipating to finish around 45 minutes or so from now. And again, the resources are available. So on the web. Next, I guess I have to do it this way. All right, so I just want to say a little bit about cows and myself. I'm trained both as a social worker and an economist. I'm mostly a labor economist. I'm not a macro person. I do not, I've not been trained in a lot of the stuff that you all look at. I look a lot at workers, the structure of jobs, and the policies and institutional infrastructure that influence the relative position and power of workers in the labor market. We put out a report every other year at COWS. I mean, every year. It's shorter every other year, but hardly noticeable now. Called The State of Working Wisconsin, and it provides a worker's eye view on what's going on in the economy. That workingwi.org link gives you the website that holds all those reports. And that's mostly what I'm going to draw on here. But I wanted to tell you a little bit about cows. In fact, I want to point out the cow's idea is sort of held in this picture, and I wanted to hold it up. The basic observation structuring nearly every project at cows is that there is a high road way to do things and a low road way to do things. And in the United States, policy tends to be, and that is a question of employer or firm practice. It is the decision by a firm to either, sometimes my boss, Jill Rogers, says, treat workers like roadkill and the earth like a sewer. Extreme way to say what that is to say to operate with indifference to the social impact either on workers or the environment of the firm's operation. Call that the low road. And the high road is competitive under current conditions, but also much more attentive to human capital, workers' contribution, driving up productivity, delivering the productivity in wages to workers, and preserving in the long term the environment. This is what we call the high road. And I think as we can see this again and again in the economy, a kind of indifference to whether a firm is operating in a way that is socially productive in terms of the long-term frame on the environment or the lives of workers in the community. And when public policy is indifferent to high road versus low road choices, what happens is, and you can see the low road is represented by that little gray circle at the bottom of the slide. The high road floats it above it in green. But when public choices are indifferent to high road and low road approaches, low road competitors get to outrun or drive down margins of high road of high road firms. This becomes the way of operating. You can think about when Walmart moved into the grocery industry. Grocery stores is especially true, well documented for California, but I think it's true across the nation. Grocery stores had strong unionization, and workers in grocery stores across California had health insurance through their employment. Walmart came in with an employment model that offered no health insurance, which meant they had lower operating costs. They could take the price then down on the food, outcompete the other grocery stores on essentially the degradation of labor standards, and win that way. That's the question of what are the standards we hold up for the economy, and how do we make sure that we are trying to choose the high road rather than actively allowing the low road to dominate the economy. I got to check the oh, sorry. Yeah, what is cows? Cows. Yeah, I see this in the chat. In truth, right now, we have worked outside of the state of Wisconsin so much, and it confused funders that the Center on Wisconsin strategy, it was obviously a kind of jokey name, just because Wisconsin. I find that the closer I am to Wisconsin, the more people find it funny, and the further away I am when I'm in New York, people feel very kind of mortified for me that I work for a place called Cows. But in any case, originally it was Center on Wisconsin Strategy. We've gone just to Cows. So you won't find it always Center on Wisconsin Strategy, but because I do a lot of work in Wisconsin, I sort of do both. Do both. And I will get to this question requiring labor and union representation on corporate boards. I actually, James, thank you for the question. I don't have an answer on that. I will have some ideas about why that's important, but I don't know corporate structure, corporate board stuff. So for now, I'll just note that I saw that question, and it is true. I will check the chat. So if you got stuff. Okay, so back to this next slide. So Cows, pays a lot to democracy, sustainability, and equity. We have projects working with a national network of mayors, projects working with departments of transportation, a lot of different issues. I'm really the labor and jobs and Wisconsin economy person. So that's what I'm going to settle down on here. But if you go to cows.org, you'll find these other projects, other resources, also a way to sign up for our about weekly, every other week newsletter called Cows Notes. So I'd invite you, and we're on Facebook and Twitter. So I'd invite you to engage with us in any way you'd like. Now to the economy. So this is me pulling on Job Watch from workingwisconsin.org, and the link might be fun for you because you can choose to set the frame or whatever. But I'm going to show the whole. You can mess with that data online. But here I'll just show the slides that you would get if you went straight there. This is what you know about what happened in the COVID recession in March 2020. The national and Wisconsin economies shed more than 10% of their jobs. That's job loss that is greater than twice the Great Recession job loss and the financial collapse of 2008, which you can see right there. That was a 7% job loss. This collapse, as you all know, was historic. And totally unique. The recovery also completely different because, right, the collapse, the global financial crisis of 2008 was underlying financial crisis. What this shutdown was it's not a recession in the traditional sense that demand falls apart. It's a recession, it's a contraction due to a public health order, right? So the economy shut down. More than 10% of workers lost work. This disemployment is concentrated in workers who work in places where we gather. Those are the places that are most impacted by the shutdown orders. And so that's retail and food service workers, half of jobs gone in there in that month, and entertainment venues, hotels, et cetera. So leisure and hospitality, super hard hit. And one of the reasons I want to kind of point this out, this difference out, is that in 2008, when the economy tanks, of course, the first place that demand goes away is houses and durable goods. And that means that manufacturing workers and construction workers lose their jobs disproportionately and it kind of more brutally. But manufacturing workers and construction workers are actually in industries that know they are cyclical and have stronger supports for disemployment. Restaurant workers have the lowest wages in the first place, the most volatile hours, and the systems that have been built to support workers through contractions like unemployment insurance are not really designed in ways that work for restaurant workers. They often are ineligible on the wage front. Their wages, because of the way tips work, means that they don't qualify for very big. Anyway, so you see that the system is not really well set up for the workers in that contraction. And a lot of what the federal government steps in and does is try and shore up a kind of social safety net that is more designed for a traditional contraction than for a public health ordered shutdown. You can also see probably in that the recovery is intense and quick, right? Like if you look back to the 2008 recession, we had a very slow recovery, even to get back to 2008 levels of employment in the nation or the state. It took about 10 years to get back. We're almost back, both at the national and state level, to the number of jobs we had before the recession here, just a little more than 2 years since that intense contraction. So that's the picture of jobs, and you can go and pick any state you want and change the time frame on this if you go online and check the chart there. The next chart is jobs by industry. Again, if I had shown you this even a year ago, the most intensely impacted sector would be that leisure and hospitality. Right now, you can see that government and other services are more impacted than leisure and hospitality at this point. That's how much recovery there has been in leisure and hospitality, and how the contraction on the government side has continued. Also, the natural resource and mining might sort of stand out to you, though this is a very, very tiny sector in Wisconsin, if you know that too. So that one's almost no people. That difference is almost no people. Unemployment looks like this. You probably already know this. You know that Wisconsin always has a lower than national unemployment rate. You know that, and that's true. You can see that all the way across, even during the recession. You can see that unemployment spikes. We're back to well below national rates, and we're actually below where we were in February 2020. So that's probably something you know. This is unemployment by county. It's very unevenly distributed. I would draw your attention to Dane County at 2.2, La Crosse up there at 2.6. These ones that are below 3%, mostly in the southeast. But that's pretty low unemployment. Some economists would joke that it's below the frictional rate, which means there are people who are working who shouldn't be working. Haha, that's a little joke for economists. I mean, it doesn't really count. Why is let me try this again. There we go. Okay, but here's the thing. And I think I really want to focus on this because I think our labor shortage conversations are a little blind. In February 2020, I think one thing is that there's been a lot of talk of a great resignation. There's been a lot of talk of shrinkage of labor markets. There's a lot of talk about how hard it is for people to work. And I think that's true. And I think it's especially true of women. The fact is, though, in February 2020, the total labor force in the state of Wisconsin was just under 3.1 million, and the labor force participation rate in the state was 66.1%. That's high. You all know this, perhaps, that Wisconsin works a lot. It's especially true because Wisconsin women work a lot. This is how we outpace the national. It's also true that Wisconsin is old. You pay attention to the age distribution of the state more than most, I bet. And so you know that we are a relatively old state. You can see that in the fact that our population does not grow as rapidly as other states. We aren't getting as many migrants from other nations or other states, and we are aging out of the workforce. So, but the older you are up to the point of retirement, or, so when you're in the prime working years, your chances of working are higher. Because we have a older population, that labor force participation rate is also high relative to national. But the real driver of that is women. Here's the total labor force in March 2022. It's over 3.14 million. The labor force participation rate in the state right now is 66.5%. So I want you all to know that what happened was not a great resignation. What happened was not, a bunch of 20-somethings going to pursue van life, or a bunch of moms actually really dropping out of labor force. There's a little indication that moms of younger kids, especially, really struggling with the childcare crisis, have been impacted, but mostly through the stress of trying to juggle things much more than leaving the labor market. So that seems important to me, because it means that what's going on in Wisconsin is about the underlying demographic challenge that we had before the recession and that we have today. That is that more people are leaving the labor force, aging out, than are coming in. This is the underlying kind of structural issue. It isn't that benefits are too big. It isn't that people don't care about work. People are working hard in the state, and harder than they were before, or more connected to the labor market than they were before the pandemic. So that's one big takeaway for y'all. And this is just a way to see this at the national level. Hires are greater than quits in all sectors. And it's especially true that down in the lowest wage sectors, the quit and hire rates are quits and higher rates are higher. It's fun to say higher and mean different things by that, but you can see accommodation and food services has the highest quit rate, also the highest hire rate, always greater hires than quits. This is another way to see that what's going on in the economy is a great upgrading. People are moving for better work. People are leaving jobs, but they are going to get other jobs. They are not leaving the labor market. This is the picture for Wisconsin of the underlying demographic challenge in this state. You can see that percent change in total working age population. On the left, only the counties in orange have a positive increase in total working age population. And if you narrow that down to the prime age working population, 25 to 54, only Dane County and Eau Claire County have increasing prime age populations from 2010 to 2019. This is what's going on in the labor market. This is why the labor market is so tight. Wisconsin is aging, and we are not attracting enough immigrants from other countries or from other states to, kind of replace the workers that are leaving the labor market. So that's kind of the and then this you can link to the source. I've shared the slides and they'll be out, and that link is in there. It's from the Center for Community Economic Development, a nice study on what's going on with the working age population in this state. The longer term perspective I'd like to just focus on a little bit is, for me, this view from the post-war period through current. You can see in the post-war period that till some point in the 70s, from 1948 till some point in the 70s, as the economy grew, hourly compensation grew alongside it. And that is a period during which, if we asked how the economy was doing and heard that GDP was up, we could feel maybe kind of solid that that meant that median income and workers' wages were going up, right? Like these things moved together. In the 70s, those split apart, so that by the current time, while the economy makes 2.5 times what it did, or has increased by 250%, what was produced with an hour of labor in 1948. So dramatic growth there, but wages only up to, basically staying close to where they were in the 70s in real terms, adjusted for inflation. I appreciate also this Edward Frank's point about, well, this isn't really post-COVID, and that's a really excellent point. I feel like I should kind of fix the language. I guess it's post-vaccine, it's sort of new functioning. I think we don't really understand, every time we think we've got a plan or an answer on what the post-COVID reality looks like, we're wrong. So I shouldn't be calling it post-COVID. I should say pre-COVID and current, absolutely. And yes, this is not over, and I expect we'll see changes in the future. So yeah, thanks for that point. So this is just the growth. So I think when I see this, but back to this graph, when I look at this graph, I also really see, I hope that what you can see in here is inequality. When workers are making more value with their time on the jobs and they are not getting that value in wages, I think you can see what is going on necessarily is that the rewards, that value generated, is going somewhere else. In the case of the United States, and uniquely, I mean, it's true that inequality is up all over the globe, but it is uniquely and strongly up in the United States. That's also what you can see in this chart, and that's a long-term challenge that's kind of contained in here. This is what median wages look like in the state. I want to say two things, y'all. This is all workers, so salaried workers. I use a standard method to turn their salary into a wage. So if someone earns $50,000 a year, that's $25 an hour, because there's 2,000 hours of work in a year, 40 hours a week, 50 weeks a year. So they come in as $25. So yes, this is not just hourly workers. This is all workers in the state. It is the median. It is inflation adjusted using the CPI from BLS. And what you can see, right, is in 1979, Wisconsin wages slightly above the national average, both around $17.50 an hour, or $17.50 for Wisconsin. You can see that the 1980s are hard, especially in Wisconsin, where that line comes down below the national line. For those of you who are around in the 80s, that's the manufacturing restructuring of the 1980s. You can see the 1990s, the gap closes, and then we move to this point. Wages are $2 an hour, $2.50 an hour higher than they were in 1979, which is $5,000 a year, is not an enormous increase for the median worker, who we know is more educated today and working on much more productive technology and seeing a return of only $2 or so an hour. One thing you might notice about this is the extreme upslope on the last year. What's going on there? That's a composition effect in 2020 because so many low-wage workers actually lost their work. And so that strong wage growth in the 2020 number is not the strong wage growth that we've seen in the labor market. And I think we will see real wage growth next year. That's a composition effect about losing those very low wage workers. That's why wages went up that year. So even that news is not great news. Yeah. And I will get a little bit to quality of work conditions. So I will get, and I will also get to policy. So good. Let me go to the next one. I think if you look quickly at this is 79-2020 by race and gender. I guess what I would call out to this, you probably are noticing that men's wage trends are substantially negative. Even white men down slightly across the period. Women's wage trends are substantially positive. Especially white women. I think one of the things to notice about the difference between 1979 and 2020 in this state is that in 1979, men earned more than women. And in 2020, the second highest earning group is white women. The period 79 to 2020 has been especially good for, or relatively good for white women. This is especially concentrated among women with four-year college degrees. The good wage news is always at the top of the labor market over the last 4 decades. So we move from a kind of gender distinction in the labor market to a much more race-based distinction of opportunity in the labor market over this period. I think that's worth noting. The thing here, one of the policy things that I would always emphasize is the importance of Wisconsin's associate degrees and technical college system. Going and just getting a few years of college without getting a degree at all, and that is spending a few years on a 4-year campus or a few years on a 2-year campus, but never landing the degree, has almost no wage impact. In fact, actually, you can see here, it has a little negative impact, although that's, again, mostly a manufacturing legacy question in this state. Most states don't generate that. But the associate degree gets you above the state median. The state of Wisconsin produces more associate's degrees than most states and generates higher wages as a result of those degrees than most states. So this is one place I think that's really critical to invest for working people is all education in this state from the K-12 system through the 4 years, but not leaving out the strength of the 2-year system. I want to talk about the three things that I think are going on that are really problems in this labor market that are more revealed today than they were 2 years ago. And because of COVID, I think one thing that is unique about the United States is we really don't invest in the care economy in a very intense way. And I mean the care of littles, kids before they get to school, from birth to the time they go to school. There's very little and very uneven investment in those, like once you get to the public schools, you're a public good, and there's a lot of investment there. But in the early years, it's very underinvested. And then our home care and long-term care systems, both institutionally based nursing homes and in-home based long-term care, is another place where the job quality standards are very low. The turnover is high. The quality of care is quite impacted and negative because of that. And so I think the care economy, for those of you who are moms and have dealt with the volatility of daycare in this crisis, in this public health crisis, or have been dealing with the schools. Also, you know, sickness coming home from the schools, just dealing with care, or dealing with your parents and trying to keep them safe, or dealing with folks in nursing homes, in the context of the highest, you know, like the first phase of suffering in the COVID crisis was in nursing homes. And it was workers paid $12.50 an hour who carried that crisis, who were the only contact for many people as they dealt with COVID themselves and could not be visited by family, who were facing the threat of bringing COVID home to their own families. And literally, many of them do not have health insurance. We have a system that has so underinvested in care work that the workers who provide the care do not actually get health insurance from their employers. Very poor job quality in too many jobs, I think, has been revealed by this crisis. I feel like this is something that was carried uniquely by the workers who are in those low wage jobs, high volatility jobs, and the structure of those jobs created a crisis in their own ability to live. Now, people can't fill the jobs because workers are finding better ones. And so employers are, I think, increasingly feeling the problem of that, but without leveling up what is going on in those jobs and returning those jobs to some schedule stability, some actual benefits, some decent wages that can support family living. I don't think you're going to see an answer there. And so I think there's a reset in our very low wage work that's going on, and you can see it in a lot of different ways. The other issue in the state is the deep racial inequality in the state. And maybe you know this and maybe you don't, but Wisconsin is one of the most, the state with the greatest distance between white outcomes and Black outcomes. And that's true in poverty and wages and income and incarceration and school outcomes. And this was not true in 1979. I think for those of you, you know, sometimes it's easy to be like, well, there's always inequality. In 1979, Black residents of this state did better than the national averages for Black residents. And it was a decent set of jobs in Milwaukee, access to manufacturing and union jobs that built that city for white and Black people, but really built opportunity for African Americans along the lakeshore in our most industrialized cities. And as that manufacturing was lost, as those union jobs were lost, that was brutal for everybody in those jobs, but for Black workers who suffered very high rates of racial segregation in the housing markets, the access to external opportunities or the new opportunities that were being generated was just incredibly blocked. And we have ended up with this incredible racial disparity in the state. And thinking about solving all three of these crises feels to me like an important part of what we need to do. So I want to talk about some public policy and some private policy. And then I think we need to talk about what this means for older adults. So I'm just going to do this. So this is my list of public policy to support the labor force. You know, obviously, I've done a lot of work on minimum wages and thinking about minimum wages. As you probably know, right now, Wisconsin is one of just over 20 states that are still at $7.50 an hour as the minimum. This means, for example, that if I live in La Crosse and I want to work in a restaurant, if I work on the Wisconsin side of the border, my tip minimum wage is $2.13 an hour. I also get my tips. Technically, I'm allowed to claim, demand from my employer $7.50 an hour, but mostly because of the way tips work, folks just get the $213 plus the tips. On the Minnesota side of the border, that same worker, because there is no tip credit in Minnesota, that same worker working at a restaurant can get more than $10 an hour for the hours of work plus tips. So I think a lot of times we've talked about how minimum wages, the higher minimum wages drive employers away. The evidence on that is actually quite thin. But it's also true that in this sort of economy, our position, the position along our borders, workers will move, will drive for the better wages that Illinois and Minnesota specifically offer at the bottom of their labor markets, and a minimum wage. Obviously in Wisconsin right now, very few people are earning $7.50 an hour. But the higher the minimum wage, it lifts the wages up to $1 or $2 above. And so certified nursing assistants and childcare workers who work close to the bottom of the labor market do better in Minnesota and Illinois, even though none of them are working at exactly literally the minimum wage. The labor market floor influences the structure, and Wisconsin really needs to step towards that. Investing in care infrastructure feels really important to me. This is a question of quality of jobs, also quality of life, especially for our, the very young, the very old, and the mostly women who, because of the gender division of labor on care, the women who kind of are mostly in the work of taking care of the young and old. But investing in the care infrastructure really matters to everyone, because we will all need care at some point. We should all be, that we all live so long that we do need some support at some point, is I think something we hope for all of us. And we will have people we love who do need care, and to be so structured around a low wage model for those caregivers really is kind of a drag on the care and a drag on our communities. Investing in public education, as I already mentioned, from the K-12 system clear through tech colleges and the four-year system. I think this kind of question about equity and inclusion, and especially the question of immigration, and I saw that in the chat. Okay, so the investment in care infrastructure, I mean, the Build Back Better, looking at a specific question from the chat on the care infrastructure, Build Back Better had, I think, some really serious ideas about that. I think one thing is to consider the structure of Medicare and Medicaid and the payment rates, which are so often structured historically. So if wages have been depressed, they pull down wages. So it's a sort of reform. The investment, I think, for the long-term care workforce would be through Medicaid and Medicare policy that focused a little bit on moving wages to workers, and also probably moving serious benefits, like moving a healthcare plan to those workers. On the child care side, I think that the kind of myriad of different systems, we've got the K-3 and the K-4, and that kind of cuts out the underlying childcare system. I think that there's a lot of community leadership around how to build the birth to school care infrastructure. It includes attending to affordability, because right now that's really more than a lot of families can pay, but also the wages of the workforce. So that's a little bit more on care infrastructure. And I think Build Back Better had aspects of this, really serious investments in long-term care and in childcare, which mattered. And I would look to that kind of federal investment is the answer on that one. So back to equity and inclusion. I think this question about do we seem like a state you want to move to? Is it forward looking? Does it support immigrants? Does it support, there are very concrete things the state could do. Driver's licenses for undocumented people really matter in terms of, employers, the dairy farmers, and the immigrant community. Wisconsin has the sad distinction of having had 2 years of tuition equity for students who qualify for DACA, and then throwing that or overruling that about 10 years ago. But tuition equity for DACA students would be another signal about the state approach to immigration, for example, that we don't do. But then also, I think, signals about our investment in the future, investment in climate. These are the things that, help attract people, I think, and we've kind of moved away from that. I think worker voice really matters. I think this is an exciting moment around workers. You can see it in Starbucks or Amazon. Organizing unions is very hard in this nation. The structure of getting to a contract means that all these victories are just the start of long struggles to get towards real representation. But I think what you're seeing is more activated workers who are saying, you called me essential. Why does my work not treat me as essential? And I think this is an interesting moment for that. I do have some thoughts. Oh, this is just who wins with a higher minimum wage. It's workers at the bottom of the labor market. So half of Black workers would get a raise if we raise to $15 by 2025. That's probably just my little infographic. I have some private policy ideas for strengthening the floor, but I also think, and so I'd be happy to talk through these, but I think it's probably a good idea. So I'm looking into the questions and answers. I think the right thing to do now probably is just move into questions and discussion, unless there's anything people want me to go back to, or data that you're interested, or ideas that you have. I'm happy to go any direction on this, Sandy, and look to you for your advice.
Okay, thank you, Laura. Gary, you've been following the questions. Are there more questions that have not been answered?
Let me just quickly go through them again, because it's kind of confusing. You were going to talk about labor representation on corporate boards, or did you push that to say that that's not your area of expertise?
I mean, I don't know corporate boards. I'm talking a little bit about unions. Right. I'm happy to talk a little more about unions. I think, so this is not an answer to the James question particularly, but I do think I just want to kind of highlight the way that we tend to think of unions as narrowly self-interested or narrowly working for workers. And I want to point out the broader potential impact of unions. So the first way that unions work, as you all know, is they represent workers. And in any workplace, unions raise wages because they essentially have collective power to kind of fight over how the pie gets divided, right? But I think what you see, even with this Starbucks organizing, right, is that if the threat of unionization gets real, employers begin to respond. And so you see that Starbucks is raising wages in an attempt to keep other shops from unionizing. But this is the way that unions raise wages when they get sufficient power outside of union shops. And then finally, unions work on a kind of political level to rebalance the focus of public policy towards working people's needs. So who fights for minimum wages, but also health insurance or Build Back Better? Who fights for these things structurally when we have no organized labor, we have less voices focusing on policy that rebalances towards working people. And so I feel like unions matter more broadly politically. And then I don't know, then, you know, that's my like kind of more on unions, but not particularly useful to James's specific question.
Thank you. Yeah. Did you talk a little, you started to talk about quality of work conditions, and then I think your last slide had quite a lot of things that were not wage related, that, you know, respect was the one that I remember. Of course, that was the last thing, and that's the hardest thing to get, but even just benefits and scheduling, work scheduling. I know that the nursing in particular is a field where work schedules are such a hot button issue all the time.
Yeah, I think this will be, and on the nursing side, right, it's often shortage driven, and so mandated overtime and the burnout that workers on the in nursing and in nursing homes face. And then in the home health side, for example, the hands-on home health caregivers experience taking all the volatility of demand in their own wages. That is, if my patient, my client, the person I go take care of goes on vacation or goes to the hospital, I don't get my hours. And so there's both kinds of volatility and demand going on for workers that is really hard. Some is over demanding of them, and I think nurses are increasingly organizing around that. And some of it is under you know, so much volatility that is carried by the workers. You can see this also in retail, where when the store census, like the count of people in a store goes down, they will send people home. This happens, I think, less these days because employers understand that they need to meet workers' schedule needs. So I think this tight labor market does make workers' demands around schedules much more likely to meet. But I think employers thinking pretty explicitly about schedules and how to be responsive to what workers need is really mattered. And I agree that, you know, employers, I think in the end, workers really want to see respect. That's probably the thing that impacts them the most. And they see that respect in the way that they're paid, in the way that they're scheduled, in the benefits they have, but also in, you know, whether they're listened to, quite honestly. So.
Thank you. Are there any others, Gary, that you noticed?
I don't think so. I think that she covered them
Answered all.
during Laura's presentation, and
Okay.
yeah, I think that's all I had.
Well, thank you, Laura. We appreciated it. I think you brought out some interesting facts about Wisconsin. And thank you, Gary, for handling the questions. Each year, the coalition recognizes an individual who's made a significant contribution to the Wisconsin retirement system or to the people who are covered under it. The award is named after Blair Teston, who was a nonpartisan legislative director of the Retirement Research Committee. He was instrumental in working with all parties to assure the WRS was and continued to be the strong, well-designed public employee retirement system that it is today. This year, we are recognizing not one, but two individuals who have contributed innumerable hours to helping keep WRS retirees informed and this organization, the Coalition of Annuitants, afloat. These invaluable individuals are Dick Kratz and John Madak, who have served as secretary and treasurer of the organization since 2006. John assures that the WCOA is financially sound, dues are received when due, and all bills are paid. Dick has done virtually all the other administrative tasks required to keep the organization going. He not only maintains records of our activities, but he keeps us apprised of current events relating to the WRS and what is happening with past and present board members. He is the go-to man. On behalf of the board, it is my pleasure to give each of you the Blair Teston Award. We all hope you will continue in your present positions for many years to come. You will have to receive your recognition, the official award, Dick and John, and when we get together. But thank you for your service. And in closing, I'd like to thank everyone who attended the virtual Wisconsin Coalition of Annuitants annual meeting. We hope you found the presentations useful and interesting. As retirees, we are very fortunate to be covered under the WRS. We hope your confidence in the WRS has been confirmed, and we also hope you learned of some issues facing seniors and services available that may help you or someone you know. Finally, I would like to thank Rick Wojcik, our tech guru. Without him, this program would not have taken place. Thank you, Rick. Please take a moment before you rush off to complete our brief survey. When you push the red button, leave meeting button, you will be directed to our survey. Completing that will help us in planning for future conferences. Thank you again for attending, and stay well until next year. Bye-bye.